Bank of England, created for war, governing money. The Bank of England sits at the center of global finance. Textbooks call it an institution of monetary stability, but it was founded in 1694 to finance war. A desperate monarch needed large, long-term loans after traditional lenders and short-term credit failed. Private investors agreed to lend money to the crown in exchange for a corporate charter, tax-backed interest payments, and the right to issue paper notes redeemable for coin. That deal established fractional reserve, credit money tied to government debt. The bank's power came from controlling state finance, major expenditures, wartime funding, and public projects flowed through its machinery. Shareholders became gatekeepers of sovereign credit and received a steady revenue stream drawn from taxes. Critics warned of perpetual debt, shifting power toward financiers, foreign influence, and a system that made the bank effectively too connected to fail. Those warnings proved prescient. The original loan was never repaid but refinanced into enduring national debt. Early crises tested the system. A 1696 recoinage triggered a run, forcing temporary suspension of full convertibility and tighter cooperation with the Treasury. Yet survival enhanced the bank's credibility and role. Repeated wars and emergencies, the War of the Spanish Succession, Napoleonic conflicts, world wars, financial crises, and modern pandemics, required new borrowing. Each episode expanded debt, strengthened the bank's position, and normalized using central bank credit to support government spending. The Bank of England's model spread internationally. Variations emerged. France's speculative experiments in the early 18th century collapsed. The United States vacillated over central banking before adopting a Federal Reserve in 1913, but the core elements endured: a privileged institution close to government, issuing currency and providing sovereign credit. In modern practice, central banks still create money by buying government bonds. Quantitative easing during crises credits treasury accounts and enlarges central bank balance sheets, shifting future burdens to taxpayers through interest payments. The incentives embedded in the 1694 design, political convenience for borrowing, private profits for bondholders, and expanding central bank power, remain largely unchanged. You interact with this system daily: wages, taxes, mortgage rates, savings returns, and access to credit are all shaped by institutions descended from that original arrangement. Understanding this history clarifies why governments prefer borrowing to taxation, how safe assets are produced, and how monetary policy serves both public needs and private interests. The Bank of England today administers an apparatus born of a 17th century emergency, and its ledger has never been closed.